Yes, friends, welcome back. So, several models we have seen how to compute cost of equity in that context. Uh, Sharing the screen once again with you. And this model we'll be discussing now, which is called as CAPM or Capital Asset Pricing Model. Okay, so this model, try to understand. It may appear to be a little complex again, but again, very simple model. Yeah, just give me 1 second. Yeah, here you see this model. If you look at here, a same formula is given. Here the formula says cost of equity is equal to RF plus beta into RM minus RF. To understand this formula, some concepts we need to understand it before. Uh, right, here RF stands for risk-free rate of return and RM stands for return from the market. B stands for beta, market beta. So first, let me show you this particular chart. Look at this chart where it is talking about systematic risk and unsystematic risk, two components. Right. When you'll be learning the subject called as the portfolio management, you'll be understanding that if you increase the number of your investments in securities, risk reduces. For example, let us say you're investing only in one company's share. It may be any company. You're investing in a particular company's share in the share market. And there is a risk. Suppose your investment is only one share, there is a risk. Or one company you are making investment, there is a risk. If you invest in two companies, risk will be less. If you invest in three companies, risk will be further less. That means if you increase the number of securities, the risk line will go down. Risk line will go down. Why it is so? Suppose you are investing in one particular company. Let us say an IT company. If IT sector is down, then and you will be suffering losses. So risk is more. But you are investing in one IT company and one other pharmaceutical. Here risk will be less because if IT sector is down, pharmaceutical company may not be down at that point of time. Let us say you are investing in three sectors: IT sector, pharmaceutical sector, and banking sector. Let us say IT sector is down, other two sectors may be showing good results. So therefore, if I increase the number of securities, the risk goes down. Risk goes down, that does not mean that risk will become zero at that point. Risk, you can reduce the risk by increasing the number of security up to a certain extent. Beyond that, the risk line will behave like a straight line or a parallel line. It will not go down. Because there is some part of the risk which is already embedded in the system. It is within the system, within the financial system. That risk we call it as systematic risk because by increasing number of securities, you cannot reduce it. We call it as the systematic risk. What we can reduce, that is called as unsystematic risk or controllable risk. This risk you can control. Now we have understood that entire risk we are dividing into two parts. One is systematic, other one is controllable or unsystematic risk. The risk which can be reduced should be reduced. And risk which cannot be reduced needs to be measured. So this systematic risk is measured by using a factor called as the beta. As you know, risk means what? Risk means the fluctuations from the expectation. What you are expecting and what you are getting. If there is a difference, that is called as risk. Okay, and this beta refers to the sensitivity of a particular stock with reference to the market. Let us say market is going up by 10% and this stock is going also by 10% up. That means this particular stock is exactly following the market. In this case, we can say beta is 1. That means it is mimicking the market. It is a replica of the market. But let us say market is going at 10%, but this stock is growing at the rate of 20%. That means this particular stock is doubly sensitive. That means beta factor is 2. It is overreactive to the market. Market is going up by 10%, but this is going up by 20%. So beta factor is 2, sensitive factor is 2. But market is going up by 10%, it is going up by 5%. That means what? Beta factor is 0.5. This is less reactive or less sensitive to the market. So this sensitivity factor is measured by using the concept beta. Now here this formula says that investor will always be expecting the risk rate of return. This is the minimum return he is expecting, risk rate of return, always. Without taking any risk, if he is getting some money, or he is expected to get some money, that is his risk rate of return. Suppose without taking any risk, he can get 5%. So whenever you are expecting making an investment, you'll be expecting 5%. So RF plus something you want, if you want to invest money in it. So RF is the minimum. Above that, what you want, that is your risk premium you want. Since you are taking a risk, you want a premium. Okay. And above that, what you are expecting is basically one should expect the market rate of return. If market is giving 20%, you should expect 20%. But market is giving 20%, that market return also includes risk rate of return. So the net market return means market return minus risk rate of return. Because RF you have already taken here. RF you have already taken it here. So you want RF plus RM. RM means the market return. But RM, since it is also, the market is giving you return. Why market is giving return you 20%? Let us see. Market is giving you 20% because risk rate of return is 5%. But since you are taking a risk, it is giving you 15% extra. So when I'm taking risk rate of return here, the net market return is RM minus RF. And this net market return is sensitive. When market is up, this return will be more. Market is down, the return will be less. Therefore, this net return, that is RM and RF, is multiplied with this beta factor. So now the formula is RF plus beta into RM minus RF. So every investor wants this risk rate of return, this part, plus market return. Market return means net market return, which is RM minus RF. RF is already included here. But this RM minus RF is subject to beta factor. So now the formula is again RF plus beta into RM minus RF. Okay. So if you know this formula, if data is given to you, you'll be able to compute cost of equity. So what is beta if someone is asking you? It is the measure of non-diversifiable risk, or it's a measure of systematic risk. Systematic risk is not diversified. That is called as non-diversified risk. On systematic risk is diversified risk. Okay. So by using this formula, you'll be able to compute cost of equity. This beta can be more than 1, can be less than 1, can be equal to 1. If it is equal to 1, you can say unit beta. It is making the market. If it is less than 1, you can say it as a low beta, or the stock is defensive stock. If it is more than 1, you can say it's high beta, the stock is aggressive stock. It will overreact to the market. There are various formulae to compute this beta factor. Here is one formula you see. Formula may not be relevant for you in your syllabus. So beta is equal to standard deviation J by standard deviation M multiplied with correlation between J and M. J refers to the return of the stock. M refers to the returns of the market. That means stocks return divided by market return multiplied with the correlation between stock and market. Here is an example. If this data is given, you can compute beta or compute KE. From the following data, compute KE. RM is 10%. Standard deviation of the security is 20%. Risk rate of return is 4%. Standard deviation of the market is 15%. Correlation between stock and market is positive 0.8. First, we will be able to compute beta, then you can apply the formula RF plus beta into RM minus RM. So you see, this is the formula in fact. KE is equal to RF plus beta into RM minus RF. So RF is 4 plus beta is 1.7. How beta is calculated? This working source. Standard deviation of the stock divided by standard deviation of market into correlation 0.08. It comes to 1.07. This 1.07 will be multiplied with RM minus RM. RF is 10%, RF is 10, RM is 10%, RF is 4%. So if you put this figure, it comes to 4 plus 1.07 multiplied with 10 minus 4. Or it becomes 4 plus 6.42. So KE is equal to 10.4%. Look at here, you'll be able to understand. Okay. This is how cost of equity you can come. Now, let us see how to compute the cost of internal equity. Internal equity means reserve or retained earnings. Retained earnings or reserves are not cost-free. But you know, these reserves belong to the equity shareholders. So cost of equity and cost of reserve are same, with only one difference, that when a new share is issued, normally there is a flotation cost. Flotation cost means a issue cost. But when reserves are there is no issue cost. Reserve does not involve any issue cost. Therefore, only modification, there will be a small modification in the formula. For example, KE, you know, D1 by P0 plus G. But P0 means what? Price as in today. Suppose today's price is 100 rupees. Then we'll take 100 rupees. But if there is a flotation cost, that means to issue the shares, you have to spend 5 rupees. That means actually you are not getting 100 rupees. 100 rupees the price, but there is a issue cost of 5 rupees. That means actually you are getting 95 rupees. So if you modify the formula, it says KE is equal to D1 by P0 minus F plus G. If flotation cost is not there, you can say D1 by P0 plus G. That formula we already know. Okay. But in case of reserves, there is no flotation cost. So cost of reserve is simply D1 by P0 plus G, which you have already learned. That is the cost of equity you have learned. So KR or cost of reserve is equal to D1 by P0 plus G, and cost of equity is equal to D1 by P0 minus F if flotation cost is given to the debt plus growth. This is how we'll be able to compute cost of retained earnings. Here is an example. Just have a look at this. The share of the company is currently selling at ₹100. It wants to finance its capital structure, capital expenditure of 1 lakh, either by retained earning or by selling new shares. If the company sells new shares, the issue price will be 95. That means 5% discount. So you can say 100 rupees minus 5 rupees flotation. The dividend for the next year is equal to 4.75. That means D1 is equal to 4.75. Expected to grow at the rate of 6%. G is equal to 6%. Question is asking you to calculate cost of internal equity and the cost of external equity. Very easy. Apply that formula. Internal equity means reserves. External equity means cost of equity you have to calculate. So external equity formula is D1 by P0 minus F plus G. Internal equity formula is simply D1 by P0 plus G. Okay, first we'll calculate cost of equity, which is the external equity. You see D1 by P0 minus F plus G. So 4.75 is the dividend. Minus 95 money one will get plus 0.95 means 100 minus 5. Plus growth is 0.06, 11%. What is cost of reserve? Only thing is that this flotation cost will not be there. So the formula is D1 by P0 plus G. it comes to 10.75. So cost of external equity is more than cost of internal equity because of this flotation cost. Okay, hope you have understood this thing. Next class, again, I'll be repeating the cost of reserves. Okay, from that, we'll be learning. After that, we'll be learning about cost of preferred shares and then WACC or weighted average cost of capital. This is how we'll plan to proceed out. Thank you.